Welcome back to the deep dive. This is where we grab that overwhelming stack of information on a really complex topic and, well, we distill it down. We give you the essential nuggets of insight, making you the most informed person in the room quickly and thoroughly.
And today, we are undertaking a deep dive into something that, it literally defines the relationship between citizens and their governments.
Yeah.
Income tax.
Right.
It's an essential, almost universal mechanism, but the history behind it, the complex mechanics and the economic consequences are just profoundly misunderstood.
Exactly. We all interact with it. You see it on your pay stub, you file a return. But how many of us genuinely understand why the systems are built the way they are?
Right.
Why are my wages taxed differently than, say, my investment returns? Or why would a country even try to chase income all over the globe?
Our source material for this is pretty ambitious. It gives us a really structured, comprehensive overview. It traces income tax from its earliest and sometimes shockingly modern-sounding precursors right up to the policy dilemmas we face today.
Things like international tax competition or bracket creep.
Bracket creep, the never-ending battle against avoidance, all of it.
So our mission today is to give you the framework to understand not just, your own tax situation, but the whole global architecture that governs how governments finance pretty much everything they do. Let's start with the basics. What are we actually talking about here?
At the highest level, income tax is just a levy. It's imposed on a taxpayer. That could be an individual or an entity based on their specific calculated income or profits.
And we call that taxable income.
We call that taxable income. And the fundamental calculation is, it's very simple. The tax rate multiplied by that taxable income. That equals the amount you owe.
That sounds deceptively elegant.
It is.
And yet that simple equation somehow generates tax codes that are thousands of pages long.
Because the devil is entirely in the definitions. It all comes down to the complex, sometimes, frankly, arbitrary determination of what counts as taxable income, how you apply the right rate.
And those definitions, they determine everything.
Everything. From how a billion-dollar company structures its global supply chain to how, a new parent decides whether it's even worth it to go back to work.
Okay, let's start with those rates, because this is where you can instantly see the policy philosophy of a nation. And globally, there are really only two main ways to structure them.
That's right. First, you have the progressive or graduated tax rate system. This is what most people think of when they hear individual income tax.
So talk to us about the philosophy behind that. Why not just a single, simple rate for everybody? What's the point of progression?
Well, a progressive system is built on this core principle of ability to pay. It's a mechanism that's specifically designed to distribute the tax burden. How? By increasing the marginal rate as taxable income goes up.
So it's not just about collecting revenue.
No, not at all. It's an explicitly social policy tool.
We hear about tax brackets all the time. Can you just nail down what that looks like in practice for us?
Sure. In practice, it means your income is divided up into tranches or brackets. So, for instance, the first, say, $10,000 of income might be taxed at 0% or maybe 1%. That's designed to protect low-income earners.
Right.
But the highest tranche of income, let's say everything you earn over $500,000, that might be taxed at 35% or even more. This structure ensures that, on average, a high-income earner pays a much higher proportion of their total income to the government.
And this progressive design, it's almost universal for individuals. But when we look at businesses, at corporations, we see a totally different philosophy.
Yeah, we shift almost entirely to a flat rate system for corporations in most places around the world. Here, the tax rate just stays constant. It doesn't matter if the corporation earns $1 million or $1 billion in profit.
Why do governments just throw out that ability to pay principle when it comes to companies? What is the rationale for a flat corporate rate?
There are a few arguments. The main one is the need for stability and predictability for business planning.
I see.
Corporations have to forecast their tax liabilities years in advance to make huge investment decisions. A constantly shifting progressive rate schedule, well, that introduces a lot of volatility.
So that's one reason.
The second big argument is that, corporations don't really bear the tax burden themselves. They just pass it on.
To who?
To consumers in the form of higher prices, or to their employees with lower wages, or to shareholders through lower dividends. So the argument goes, applying a progressive system to an entity that's just a collection mechanism is, well, philosophically kind of pointless.
That is a fascinating trade-off. You're basically sacrificing that social equity goal at the corporate level for the sake of economic stability and encouraging investment.
Precisely. And that leads us right into defining who exactly is paying the tax. We've mentioned individuals and corporations, but the world of taxable entities is a lot more nuanced than that.
And I know the U.S. is a huge outlier here, right, when it comes to defining what a business even is for tax purposes.
It really is. Globally, most systems tax an entity based on its legal formation. A corporation is a corporation. End of story.
It's simple enough.
But the U.S. system stands out because many entities can actually elect their tax identity. They might be legally organized as an LLC, but they literally check the box to be treated as a corporation or as a partnership for tax purposes.
And that flexibility, that choice, must be a huge lever for tax planners.
Oh, it's a massive planning opportunity. And that brings us to the other major structure, partnerships.
How are they treated?
Partnerships are generally treated as pass-through entities. The income, the deductions, the credits, they don't stop at the business level.
They pass through?
They pass directly through to the individual partners who own the business. Those partners then report their share on their personal tax returns, where the progressive rates apply.
And the goal there is to avoid what they call double taxation.
Exactly. You want to avoid taxing the business and then taxing the owners again when they take the money out.
Okay, so we've covered the structure of the payer. Is it an individual, a corporation, a pass-through? But what about the source of the income? Are my wages treated the same as my dividends?
In most systems, the source of income absolutely matters. And this gets us into income variances and exemptions. Income from investments, things like dividends, capital gains, interest, is very often taxed at different and usually lower rates than your active wage income.
And what's the policy driver behind giving investment income a break?
Again, it's mostly an economic incentive. It's aimed at capital formation. Governments want people to save, to invest, to risk their capital because that's what drives economic growth.
So if you tax it too heavily,
If the return on that investment is heavily taxed, people are just more likely to spend their money rather than save or invest it. And, there's all of that double taxation idea again. The corporate profit was already taxed once at the flat corporate rate, so taxing the dividend that comes from it at the full individual rate is seen by many as excessive.
and speaking of not taxing things, certain organizations are just taken out of the system entirely.
Yes. Almost every jurisdiction in the world recognizes the public good that's provided by, schools, hospitals, social welfare groups. So local charitable organizations are almost universally exempted from income tax. It's a deliberate policy choice to encourage private funding for things that benefit the public.
Okay, last thing before we leave these building blocks, we have to talk about the most powerful tool in the toolbox, the tax credit. What makes a credit so different from a deduction?
This is a really crucial distinction. A deduction only reduces your taxable income base. So if you're in a 20% bracket, a $100 deduction saves you $20 in actual tax.
Okay.
But a credit is a dollar-for-dollar reduction of your final tax liability.
So a credit hits the final bill directly.
Precisely. If you have a $500 tax bill and you get a $100 credit, your bill immediately drops to $400. Credits are a much more potent and therefore more expensive for the government policy tool. But their function is uniform everywhere.
All right, now we get to jump back through time and see how this incredibly complex system actually came to be. When we think of tax, we often think of simple things, levies on land or sales. But a modern income tax requires some serious administrative sophistication.
Oh, absolutely. For a government to even attempt a modern income tax system, you need a few key things. You need a functioning money economy, not barter. You need systems for accurate accounting.
A common understanding of what profit even means.
Exactly. A common legal understanding of receipts, expenses, profit, this whole idea of net income.
Right.
And crucially, you need reliable records and a bureaucracy strong enough to enforce it all.
And that structural requirement is why those older systems, like tithing, which focused on a piece of your gross output, were so fundamentally different from what we have today.
Right. Tithing and ancient property taxes, they were assessments on gross items or on wealth ownership. They didn't have the precision you need to calculate true profit or the net increase in your wealth over a specific period.
But there's one really surprising detail in our sources that shows this idea of taxing net income isn't new at all.
It's not. The history books take us way out of Europe, all the way to 9 CE China.
To the Qin dynasty?
Yes, to the very short-lived Qin dynasty under Emperor Wang Mang. Our sources pinpoint this as the very first documented income tax that was based on the principle of net earnings.
This is just fascinating. What prompted this massive administrative leap 2,000 years ago?
Wang Mang was a really ambitious reformer. He established a 10% tax, but not on everything. It was on the net earnings from specific activities: non-agricultural trading,
Yeah.
fishing, wild herb and fruit collection, shepherding.
The sheer administrative complexity of trying to define net earnings for, say, a rural trader in 9 CE China it's just astonishing.
It is, and the compliance mechanism they developed sounds frighteningly similar to what we do today.
How so?
People were required to self-report their income. And just like today, the government didn't just take their word for it. Officials would actually audit the self-reported figures to check for compliance.
And I'm guessing the penalties for getting caught were not small.
Not at all. They were brutal. Tax evasion was penalized with a full year of hard labor and, this is the kicker, confiscation of all your property.
Wow.
And penalties that severe, they suggest the system was incredibly difficult to enforce and probably met with immediate resistance, which it was. It was abolished in 22 CE after only 13 years because of widespread popular discontent.
So, a short-lived but radical experiment. Now, jumping forward, early Rome had taxes, but they weren't based on annual profit, were they?
No, Rome had a wealth tax. During the early Republic, they had these modest assessments, usually 1%, maybe up to 3% during a war, but it was applied to property you owned.
Yeah.
Lands, slaves, money. It was a snapshot of what you had, not a calculation of what you earned.
Then we hit the medieval period with the very famous Saladin tithe.
Right, the Saladin tithe in 1188, imposed by Henry II.
Yeah.
This starts to look a lot more like a precursor to an income tax. It required 1/10 of a layperson's personal income and their movable property, and this was in England and Wales. The money was to fund the Third Crusade. So it was an emergency measure, but that specific link to personal income suggests a real evolution in how they were measuring wealth.
And then finally, 17th century Portugal gives us a truly early modern example.
In 1641, Portugal introduced the decima, which was specifically categorized as a personal income tax. But while you see these examples popping up, the real inception of the modern, structured, progressive income tax, the direct ancestor of what we know today, that's 1799 Britain.
Tell us about that. This was William Pitt the Younger, and the context was the French Revolutionary Wars.
Exactly. Pitt needed a huge amount of money to fight Napoleon, and the traditional methods just couldn't raise the kind of sums required. So in 1799, he introduced the tax, but, and this is important, he introduced it explicitly as a temporary war measure.
And it was progressive from day one.
Yes, although modestly. It started at a tiny rate for lower incomes, 2 old pence in the pound for incomes over 60 pounds, and it climbed progressively to a maximum of 10% on incomes over 200 pounds. So that concept of capacity to pay was baked in from the start.
But the tax was incredibly unpopular precisely because it was supposed to be temporary and linked only to the war. This led to that wonderful story when it was repealed after Napoleon was finally defeated.
Right, so when it was abolished in 1816, after Waterloo, the opposition was so loud and so angry that they demanded all the tax records be publicly and ceremoniously destroyed. It was a signal that this tax was dead forever.
And the government agreed.
The Chancellor of the Exchequer complied. He publicly burned the records.
But the bureaucracy, as always, had the last laugh.
Exactly. We know the copies of those records were secretly kept in the basement of the tax court. It's just a perfect example of the enduring administrative instinct of government. Even when you're defeated politically, information is power, and records are never truly destroyed.
And despite all that opposition, income tax eventually came back to the UK as a permanent thing.
It did. That happened in 1842 under Sir Robert Peel. And Peel was initially against the tax, but a severe and persistent budget deficit basically forced his hand. He reintroduced it, and despite all the opposition, it eventually became, grudgingly accepted as an indispensable part of government funding by the mid-19th century.
And the story in the U.S. really mirrors that pattern. Wartime necessity driving fiscal innovation.
Absolutely. The U.S. federal government brought in its first personal income tax in 1861 to fund the Civil War. It was a modest 3% on incomes over $800. It was quickly changed, later repealed. The first real peacetime attempt didn't come until 1894.
And that 1894 tax, it was meant to replace lost tariff revenue, but it ran into a much bigger problem than political opposition. It ran into the Constitution.
That is the critical pivot point in U.S. tax history. The Supreme Court ruled the 1894 income tax unconstitutional. The 10th Amendment required direct taxes to be apportioned among the states based on population. The court decided that a tax on income from property like rent or interest was a direct tax and therefore had to be apportioned, which for an income tax is administratively impossible.
So the U.S. system was just legally stuck. They had to literally change the foundational law of the country.
Correct. That monumental change was the 16th Amendment in 1913, and it specifically gave Congress the power to lay and collect taxes on incomes, quote, from whatever source derived, without apportionment among the several states.
And that amendment was like opening the floodgates.
It was. Revenue soared. It passed the billion-dollar mark by 1918, and the rates began this dramatic fluctuation that you see throughout 20th century tax policy.
Wild swings.
Absolutely. From a low of 1% in the early brackets to these staggering highest marginal rates of over 90% that were used to fund World War II, it just shows the incredible power of income tax as a lever for massive governmental mobilization.
And if you look at the global timeline, once the UK and US models were in place and working, adoption just became rapid. It was mostly driven by industrialization and the need to fund big state projects or wars.
You see it everywhere. Switzerland in 1840, Japan in 1887, France starts to evolve its system in 1872, Canada in 1918. And it's important to remember this isn't a finished story. I mean, Uruguay only introduced a personal income tax in 2007.
Wow.
So this transition from systems that rely on tariffs or consumption to systems that rely on income, it's a global, continuous process.
So history shows us that income tax is sticky. Once it's implemented, it's really hard to get rid of. Now let's transition into how this money is actually collected today, focusing on the shared mechanics that really bind almost all global systems together, no matter the local politics.
The first and most important shared principle, the one that immediately dictates how complex your tax life is the system of residency rules and worldwide taxation.
Okay, we need to really clarify the fundamental difference here. How is a tax resident treated versus a non-resident?
Okay, so a resident, and that can be a person or a company, is generally subject to tax on their worldwide income.
Worldwide.
Worldwide. So if you're a tax resident of Germany, you have to report the income from your job in Germany, but also from your rental property in Spain and from your investments in Asia. All of it.
That is incredibly expansive. What about the non-resident then?
A non-resident is taxed only on specific types of income that are sourced within that jurisdiction. So if you live in Canada but you own a building that generates rent in Germany, Germany is only going to tax you on that specific rental income from the German property.
So how do countries define residency for an individual, especially now in a world of remote work and global travel?
For individuals, the rule is often pretty quantitative and simple. It's a physical presence test. If you're physically present for more than 183 days, so roughly half the year, you're often deemed a resident for tax purposes.
And for companies?
For corporations, it's usually based on either the place of legal organization or, and this gets more complex, where the company's management and control actually happens.
This dual system immediately creates the potential for double taxation.
It does.
If I'm a German resident, but my Spanish property is taxed in Spain, I'm being taxed twice on the same money.
And that is the single biggest challenge of the worldwide residential system. Double taxation happens when one country claims you as a resident and another country taxes you as a non-resident on the income you earn there.
So how do they fix this?
To mitigate this huge barrier to global trade and movement, nearly all countries enter into double taxation avoidance agreements, or DTAs.
DTAs sound incredibly important. How do they actually work?
A DTAA is a bilateral treaty between two countries. It dictates which country gets the first right to tax a specific type of income, and, maybe more importantly, it ensures that the resident country has to offer relief for the tax that was already paid to the source country.
And they do that with a credit.
Usually with a foreign tax credit, yes. That offsets the tax paid somewhere else. Without these thousands of treaties, global business would just grind to a halt under crippling compounded tax burdens.
It's important to remember, though, that a few jurisdictions just completely reject this worldwide tax model.
They do. Places like Singapore and Hong Kong, for example, they operate largely on a territorial basis, even for their residents. They only tax residents on income that's earned in or actually remitted to the jurisdiction itself.
And that's a deliberate choice.
Oh, it's a very deliberate design choice, often aimed at making the jurisdiction extremely attractive for internationally mobile wealth.
Okay, let's move on to the second fundamental shared principle, defining taxable income. For residents, you said the definition is generally broad. What are the key things we see included everywhere?
Income is broadly defined as any receipt that enriches the taxpayer. This includes compensation for services, wages, salary, bonuses, but also things like the net gain from selling property, interest, dividends, rent, royalties, annuities, and pensions.
I want to focus on that detail. Net gain from the sale of property. Why is that wording so important to the idea of fairness?
Well, it's the difference between taxing wealth movement and taxing wealth generation.
Explain that.
If you buy a stock for $100 and you sell it for $100, no wealth was generated. So you shouldn't be taxed, even though $100 passed through your hands. Tax is only imposed on the $10 of net gain if you sell it for $110. And that concept applies to real estate and other assets globally.
Are there any universal exclusions from this broad definition, things that are left out for policy reasons?
Yes. Two big ones are common globally. First, national retirement payments are often fully or partially excluded from current income tax. That's a policy choice to encourage retirement savings, or maybe to just defer the tax until retirement.
And the second?
The second is employer-provided health care benefits. They're typically excluded. And this is a subtle but massive subsidy that governments use to encourage employers to provide health coverage, which promotes public health without them having to directly fund it.
So once we have our gross income, we need to subtract the costs of generating that income. Let's talk about allowable deductions and business profits.
The principle here is foundational. Tax is imposed on profit, not revenue. So expenses that you incur in the process of generating income, running a business, renting out a property, are generally deductible against that gross income. That's why only the net income from a business is taxable.
What about non-residents? We said they're taxed on source income. Is that usually on the gross amount or the net?
Non-residents are often taxed on the gross amount of certain passive income, like royalties, just simpler administratively. However, if they're earning net business income in the jurisdiction, like operating a branch office, then they're allowed to deduct the expenses related to that local business activity.
How do systems account for long-term investments, like buying a huge piece of machinery or a factory? You can't just deduct the entire cost in 1 year.
No, that's managed through what's called a capital allowance or depreciation deduction. Systems all over the world allow businesses to recover the cost of those long-term assets over time. But here's where tax policy gets very interesting. The rules often permit businesses to recover those costs more quickly than the actual physical life of the asset would suggest.
So the government deliberately allows accelerated depreciation. What's the point of that mechanism?
It's a huge economic incentive. By letting businesses deduct costs sooner, you lower their current year's tax bill, which improves their cash flow and makes the investment more attractive. It's essentially a government subsidy for the decision to invest in new equipment or facilities, and it drives capital expenditure.
Turning to individuals, aside from business costs, what kind of personal expenses are generally deductible across different systems?
Most jurisdictions start with a notional deduction. It's a fixed amount of income that everyone gets to earn, subject to zero tax, which ensures that very low earners pay nothing. Beyond that, many systems let you deduct certain personal costs, like most famously home mortgage interest or medical costs.
Which is another subsidy?
It's another subsidy, yeah, designed to encourage specific social behaviors, like home ownership.
Okay, let's look at the administration of this. How do tax authorities even determine a business's net profit?
For major domestic companies, many countries rely heavily on their audited financial statements. The taxable income is often closely tied to the profit they report in their official books, with just a few adjustments. But for, say, a non-resident company operating a local branch where accounting is tricky, some jurisdictions simplify.
How?
They might just compute the taxable net income as a fixed percentage of gross revenues and just ignore the complexity of the local expense report entirely.
We mentioned the foreign tax credit earlier. Let's just confirm how critical that is.
It is the glue that holds the entire residential worldwide system together. Without it, the combined tax burden would just be prohibitive. Every system that taxes its residents on worldwide income has to offer this credit to stay functional and competitive.
And some countries, like the US and Switzerland, they complicate things even more with alternative taxes.
They do. They often impose the higher of the regular complex income tax calculation, or an alternative, simpler tax. For corporations, this alternative might be based on capital or gross receipts rather than net income.
And the goal there is just to make sure they pay something.
Exactly. It ensures that even corporations that manage to reduce their taxable net income to zero through deductions and credits still contribute some minimum amount to the Treasury.
Okay, now let's dive into the two major ways the money actually gets collected: administration and compliance.
The first method is withholding, or what's sometimes called pay as you earn. This is required for payments to employees and to non-residents. The employer or the payer acts as the collection agent. They deduct the expected tax amount before the money ever even reaches the recipient.
But it's so important to understand that withholding is just an advance payment. It is not your final bill.
Exactly. It's the government ensuring it has a steady cash flow. The final determination of what you owe falls to the taxpayer through the process of self-assessment.
So you have to do the final math.
You have to aggregate all your income sources, subtract your deductions, apply your credits, and calculate the actual final tax you owe. If more was withheld than you owed, you get a refund. If less, you have to pay the rest.
And this brings us to this fascinating measure of civic cooperation, the voluntary compliance rate, or VCR.
The VCR measures the proportion of taxes that are paid voluntarily, on time, and without the tax authority having to intervene. The U.S., for instance, has historically had a very high VCR, often cited as being above 80%.
Why do these rates vary so much around the world? Our source material contrasts the U.S. with countries like Germany or Italy.
While compliance is heavily influenced by a country's administrative capacity, the public's perception of government integrity, and the size of the informal economy.
The black market.
The black market, exactly. In countries with a sizable black market where transactions are unrecorded and cash-based, the VCR naturally just plummets. And enforcing tax law becomes exponentially more difficult and expensive for the government.
And finally, we need to remember that income tax often happens at multiple levels of government at the same time.
That is vital to understand, particularly in federal systems like Canada, Germany, Switzerland, and the U.S. These systems impose income taxes separately at the subnational level, so provinces, cantons, or states, in addition to the national tax.
And those can be linked or completely separate.
Right, they can be integrated, where the state tax is just a fixed percentage of the national tax, or they can be entirely independent systems with different forms and different rules.
And we can't forget the taxes that look and feel like income tax but serve a totally different social purpose. Wage-based taxes.
These are your Social Security, national insurance, or national pension contributions. While they are a levy on income, they're typically a fixed rate, often capped at a maximum annual earning level, and they are explicitly earmarked for things like retirement, unemployment, or healthcare systems.
So it's a parallel system.
It's a parallel form of income taxation, usually imposed on the employer, the employee, or very often both.
All right, we've built the history and we've explained the global structure. Now we have to look at how income tax fundamentally changes behavior and creates these policy headaches for every single government on the planet.
The core truth of taxation is that it introduces friction. It changes incentives, and ultimately it changes how people decide to spend their time and their capital.
Let's start with the most immediate effect, the effect on labor supply. Does high income tax discourage people from working?
The research here has really evolved. Earlier studies were a bit inconclusive. They suggested a minimal effect on, say, the number of hours a full-time professional might work. But more recent, more nuanced studies, especially those that focus on high marginal rates and secondary earners, they indicate a large price elasticity of supply.
That sounds very academic. What does a large price elasticity actually look like in a household?
It looks like the spouse who decides not to enter the labor force. If that second earner's income immediately gets hit with a high tax bracket, say 35%, and then they have to subtract costs like childcare.
The net benefit of working might be tiny.
It might be minimal or even zero. The tax burden reduces the ultimate reward for working and leaves many people to decide that leisure or time spent on other activities is simply more valuable than that heavily taxed income. And that reduction in labor force participation is a real loss to the economy.
And that reduction in activity, that leads directly to the concept of dead weight loss, or DWL, which sounds like something economists invented just to make taxation sound scary.
DWL is a real and a critical concept. It represents the loss of economic activity that is not collected by the government as revenue. It's just lost entirely because of the friction of the tax. It's the higher cost that income tax imposes on labor and capital.
So if someone decides not to work an extra 10 hours because the tax rate on that time is too high, the economic activity that would have been generated by those 10 hours is the dead weight loss.
Exactly. And that loss has a few components. There's the loss from productive labor or investment that just never happens. There's the distortion of economic choices, people investing in tax-advantaged areas that are maybe economically inefficient. And then there's the time and resources that are devoted to tax-avoiding behavior.
So the act of trying to avoid the tax is itself a loss.
Yes. Every hour a highly paid lawyer spends engineering some loophole instead of, say, advising a company on a real commercial project is also considered a component of deadweight loss.
And that fight against the tax system is constant. It leads to this vicious cycle of tax avoidance and complexity.
This is the never-ending arms race between the state and the taxpayer. Clever tax avoidance strategies emerge legal methods that exploit loopholes. Lawmakers then respond by adding incredibly detailed, complex, and specific legislation that's intended to close those loopholes.
And what's the result of this constant back and forth?
The entire system just becomes labyrinthine. And the crushing consequence is that this complexity tends to disproportionately benefit large corporations and wealthy individuals. They are the only ones who can afford the sophisticated accounting, the legal advice, and the tax planning you need to find and use the loopholes.
Which fundamentally challenges the whole progressive nature of the system that we defined back in Section 1.
It does. While the progressive rates on paper suggest that high-income earners pay the highest proportion, the complexity allows those same high-income earners to manipulate their taxable income downward in ways that are just not available to a median wage earner who only has W-2 income. And that fuels inequality and political discontent.
Let's move to a challenge that often goes unnoticed, working silently in the background. Bracket creep, or fiscal drag. This is a quiet, systemic way that taxes rise without a single legislator ever casting a vote.
Bracket creep is what happens when inflation pushes your nominal wages into higher tax brackets, or just increases your effective average tax rate, even if your real purchasing power hasn't increased at all.
Can you give us a concrete example of how this would work in a system that's not indexed for inflation?
Sure. Imagine in country A, the 10% tax bracket ends at $30,000. If inflation is 5%, a worker who earned $30,000 last year now has to earn $31,500 just to buy the same stuff.
Right, just to stand still.
But that extra $1,500 now falls into the next tax bracket, say 20%. So the government's now collecting tax at a higher marginal rate on money that hasn't actually provided the worker with any real benefit. The worker now has less real disposable income because their tax burden rose automatically.
So the government gets an unlegislated, real tax hike, and the taxpayer suffers a silent reduction in their standard of living.
Precisely. To combat this, some countries have chosen to index their brackets and deductions. They're automatically adjusted upward each year based on the inflation rate, which prevents this fiscal drag. But a lot of countries choose not to, because bracket creep is a politically convenient, stealthy source of additional government revenue.
Let's pivot back to the global systems and look again at that distinction between territorial and residential systems. This choice really dictates how a country sees its engagement with the world.
The territorial system is focused inward. Tax is imposed only on local income that's sourced inside the country. France, for its corporations, is a classic example. The policy choice here is to attract foreign capital by making it clear that profits you earn somewhere else won't be taxed locally.
And the residential system, used by the US and Germany, that's the global model.
It looks outward. Residents are taxed on their worldwide income. This system is philosophically based on the idea that citizenship or residence confers a benefit that you should pay for, no matter where you earn the income.
And the U.S. has that exceptional and highly complex rule regarding its citizens who live abroad.
It's highly unusual. The U.S. is almost alone in taxing its non-resident citizens on their worldwide income based solely on citizenship. It doesn't matter how long they've lived abroad or if they've earned any U.S.-sourced income.
That must create a huge compliance burden.
A massive burden for Americans living overseas. And it requires specialized exclusions and treaties just to function at all. It's a major outlier in global tax policy.
And we noted that countries will mix and match these systems, which shows there's no perfect universal solution.
Absolutely. You might have a country like Brunei that taxes corporate income but not personal income, or Singapore, which separates its treatment. It uses a residential system for individuals, but a territorial one for corporations. The tapestry of global tax is determined by a country's unique economic goals.
Whether they're trying to attract mobile wealth or fund a big social safety net.
Exactly. Or encourage local investment. It's all a trade-off.
Finally, we turn to a subject of just radical difference and, I think, great controversy: transparency and public disclosure.
This is a policy choice that fundamentally redefines the relationship between the state and the citizen. In countries like Finland, Norway, and Sweden, personal income tax filings, including the person's income and the tax they paid, are publicly disclosed.
So a citizen could genuinely look up the tax record of their neighbor, or maybe the CEO of a major local company.
That's correct. In Sweden, this practice has been enshrined since 1905 with the annual publication of the Taxeringskalendern. The philosophy here is that radical transparency increases compliance, it holds authorities accountable, and it promotes a fairer social contract because wealth and contribution are visible to everyone.
And this is in direct, stark contrast to countries like the US, where tax information is considered the ultimate private financial detail. What are the potential downsides of that kind of radical transparency?
Well, while it might increase compliance, it can also lead to social friction, jealousy, potential security issues.
Yeah.
It's a fundamental choice. Does the public good of transparency outweigh the individual's right to financial privacy?
And the Scandinavian nations decided yes.
They decided yes. Most of the rest of the world, including you and our audience, have decided no. Hashtag tag outro. So to synthesize this huge deep dive, we can really return to that core distinction. The global structure of income tax is defined by the tension between the simple, locally focused territorial system, which is designed to attract external capital,
And the complex, globally reaching residential system.
and the complex residential system, which requires this massive international web of DTAs and foreign tax credits just to manage the global movement of people and money.
And what endures through this entire history, from 9 CE China to modern Washington, is the persistence of the system and the resistance to it. Whether the challenge is external like a war that requires new funding, or internal like the constant pressure of bracket creep silently raising the income tax just adapts, it is a permanent fixture that's constantly trying to maintain its balance against the forces of avoidance and complexity.
We saw that first experiment in taxing net income under Emperor Wang Mang failed within 13 years because of popular unrest and the seizure of property. The modern state has solved some of those administrative problems, but that underlying social contract, the public's willingness to fund the government, that remains the system's most vulnerable point.
Which leads us to our final provocative thought for you to consider. Reflect on that Scandinavian model of public disclosure. If you knew definitively what your peers and your competitors earned and paid, how would that knowledge change your personal decisions? Your decisions about work, compensation negotiation, your level of trust in your government? Would that radical transparency solve the complexity and avoidance problems we discussed? Or would it simply create new and perhaps deeper social frictions? It's a point of fundamental difference in civic approach to revenue, and it's one worth exploring on your own.
A fascinating concept to mull over indeed.
Thank you for joining us on the Deep Dive. We hope you feel thoroughly informed and armed with insight into this universal but very complicated mechanism.